So the headlines are quite extraordinary. 500 funds active in India, 50 billion invested. Darius, how much money has actually come out in exits? And what is the sort of return that we've seen?
Yeah, now that certainly when you look over the last few years, that has been in some senses a disappointment from the Indian market. We've had over the last half decade or so $50 billion of investments being made in India, and this does not include real estate. However, from an exit perspective, it's a much smaller number, anywhere from 5 to 10 billion. So clearly there's a lot of pent-up demand for exits that are poised, and in some senses that has to do with the overall volatility in the market. As we all know, for a large chunk of the last few years, the IPO window has been shut, and hence exits just get deferred year to year. It's amazing how when financial markets turn down, we all become long-term investors and everything goes back one more year or one more year. But I think as we study the market and look ahead over the next 5 years, I would bet that we'd see a much larger proportion of exits to investments than we've seen in the last 5 years.
Great, thanks. So, Akhil, let me turn to you first. We've heard the statistics, we've heard the economic backdrop. Is the Indian economy or marketplace still worth investing in? Let me ask a provocative question.
Okay, well, you provoked me all right. But what provoked me earlier was that reference to Financial Times and the headlines. So I typically remember when India added, I think, the 600 millionth subscriber to its mobile phone network, a commendable achievement by any standards. And Financial Times on that day chose possibly the poorest person in India. His photograph was put out there and said that a poor country but 600 million subscribers. I don't know how many of you remember that. But for some reason, India does enjoy itself being discomforted by Western press, even when the achievements are positive, which is unlike what you would see for China. So that's the first provocation, and I think I just wanted to put the record straight on that. Now, coming back to private equity, I have seen private equity evolve from really when it was, just investments in IT and IT-enabled services, and some investment in consumer goods back in 97, 98. And then it became more mainstream around 2004, 2005. And then really everyone got excited and jumped on the bandwagon somewhere around 2007, 2008. So the development while in the first 6 or 7 years from 97 to 2004 was slow. After that it became really, it's a case of gluttony, too much of capital came into India. We possibly were not able to digest that effectively. And once the growth rate has slowed and IPOs have stopped coming in, definitely the industry has started facing challenges. What we need to do to make it better, I think, would require a different kind of question, and I can leave that. But I'll say some more challenges which were earlier there are not there today. Is one, Indian promoters are quite aware of the conditions private equity would put on them when they take the money. They are also aware of the fact that once you get money in, you have to provide an exit. This is very important because with the traditional form of investing, the only foreign investor or only outside investor, if I use the right term, was the bank. And the bank technically never needs an exit from any successful business. But an equity investor does. So this education for the Indian entrepreneur has also been done. I am very positive that over the next 4 to 5 years, we will see some good quality exits, and the Indian returns from the private equity business, which currently I think to my best knowledge is about 18% IRR as compared to 22% for China, would trend back into 20+ range, where it becomes attractive for LPs to put their monies into India.
Great, thank you. Naveen, you're, I guess, a more recent entrant to private equity in India than Akhil. What is your perspective?
Sure. Yeah, listen, so we've been looking at India for, just about a little over 4 years now. We've put probably under $400 million to work across 5 companies. So we are definitely the newer players in town. And I'd say my perspective is, when you step back from all this, it's worth reminding yourself that globally, private equity is a very cyclical industry. So, this type of, glut of capital as we describe it, and then the fall in returns, and then a natural decline, and then, followed by a rise again is just something that you see everywhere. We've seen it in the US. And when you look at India's history, it's worth reminding yourself that this is such a nascent industry. It's a 10-year-old market of which, as was just described by Darius, that 07 onwards is when you've seen this incredible rush into the market, and 07 onwards has been a horrible vintage globally, and so India is no different. And I think what's particularly stark about the India story is that unlike the rest of the world, where you had a natural progression and evolution of these markets, where you started in the late 60s with firms like Apax and TA and Warburg, which started as smaller venture firms and grew into growth firms, and then buyout firms evolved over time. You had 2007 where KKR, Bain, TPG, TA, Advent, all of the largest players in the world showed up with their wallets and ready to put money to work. And I think we skipped a full evolution cycle with India, and that's what our perspective has been. I think what I will say is, versus what we saw in 07 to today, I think it's actually becoming a much more interesting place to invest. I think the competitive intensity, in my mind, is actually coming down. And Darius mentioned it, but the stratification that's happening is real. We find that whereas there's 200-300 firms running around the market, when we're really looking hard at a deal, it's the same 5 to 10 names that are typically playing in our little niche of a market. And that kind of competitive intensity is similar to what we see in the US or anywhere else in the world. And it's tough given the relative size and scale of the opportunities in India, but I actually think we're entering the right place, and I think the Darwinian Darwinian outcome of capital being reduced, firms starting to put less money to work, having burned their hands, the number of players reducing, all those things are starting to happen. So we're actually, I think 2012, 13, 14 are actually going to be really interesting vintages starting now. And it's easy to say that, harder to sell that to LPs who are in a bad mood right now. But that's what we really feel. We're seeing some great opportunities.
Great. And Vish, Naveen just brought up an interesting point, which is what is the LP perspective here? We also talked about India and China briefly. Now LPs allocate money to where they see the greatest opportunity. You have the perspective, I guess, within your firm of having both India and China as offices, as places to deploy capital. Why should your investment committee give you money in India? And why should LPs, for example, not allocate more money to China?
But that's a good question, Shashank. I think, while we've heard the positive side of the picture, we've just finished our fundraising, and we've done a bunch of investor meetings where we've had very frank and open discussions about India, China, US, Brazil, Vietnam, Indonesia, various countries where there are capital flows. And I think there are some sobering statistics about India. Number one, as Akhil mentioned, 17-18% is the kind of return that private equity is generated versus 14.4% return that the Bombay Stock Exchange has generated. So if you look at it from an LP's perspective, who are paying 2% fee and a 20% carry versus a much lower fee pool for the mutual fund industry, they would expect some kind of alpha returns. And some of them are coming back and saying, are the returns really commensurate with the higher fee structure? So that's number one. Number two, the quality of companies, the type of deal flow, the pace of investments have all been much lower compared to China. So we've looked at 8 to 10 billion in India. China has been 2.5 times that. Even smaller countries have been, like Brazil and others, have been deploying a pretty large amount of capital. So from their perspective, when they're paying a 2% fee every year, there is a certain implicit pace of investments that need to happen. And I think all of us here around the table, will always want to invest in the right companies and not compromise on quality. And hence, the pace of investments for most of the global funds in India has been rather slow. So that's the second challenge. The third is issues around corporate governance. So there are a lot of companies, I would say out of the top 500 companies that are listed, probably a larger percentage or companies below the top 500 where there are issues of all various kinds of corporate governance. There are some large visible cases like Satyam, etc. But even in smaller companies where we have investments, we find that corporate practices are not up to par. And finally, from how do we see this panning out? And part of this is really the structural nature of the industry, where it takes a hedge fund, for example, can go out of business very, very quickly. A private equity fund takes 3 to 5 years, maybe even longer, to actually go through the dubbing in process of self-selection, right? So Naveen referred to that. I think 350 or 500 funds that Darius was talking about is clearly not sustainable with $10 billion of kind of run rate investment. So some of these funds will fall by the wayside and are beginning to as we speak, but it takes a while before things actually culminate in the firm actually going out of business. So I agree with Naveen. I think vintages 12, 13, 14 is when we will see better returns. We will see much more concentrated, much more stratified industry. We do see lessening competition. So in 2007, for example, we saw a lot of investment banking firms who had their prop books investing. A lot of fraud was created because of that. I think that has kind of gone away. There are a lot of other segments which have come up. So for example, growth investing, what everybody was doing in India. I mean, if you look at even the buyout funds, or if you look at VC funds like Bessemer's and Sequoia, etc., everyone does growth investing because everyone believes that that's the only place capital can be deployed. Now we're finding the VC model is actually working pretty nicely. There have been a lot of few good exits like Make My Trip and a few others which have given a real impetus to the VC world. There are seed funds that are doing very well. The buyouts are increasingly becoming common. TPG has a strong lineage of buyouts, and we see many more buyout deals than we saw. So we are finding now that not everyone is chasing the same growth capital bucket, but are now beginning to diversify into their areas of specialization that they have globally, and hence we'll find overall competition actually getting stratified, and in some areas actually reducing. So I think for the next couple of years things are going to be tough, despite the fact that public markets have been shut. Its deal volumes are likely to be in the $6 to $10 billion range, but I think over the long term there is no doubt that growth rates in India will pick up, and India will be not necessarily surpass China, but certainly will be a good alternative to China.
Thank you. Darius, Vish said something interesting. He painted a relatively bleak picture along a number of different lines around the types of corporate governance, around the type of kind of Me Too investing, as it were, that we've seen so far. What can GPs do to drive high sustainable returns, which effectively is what LPs are looking for? Is it around specialization by type of deal? Is it by sector? How do you do it?